Hi, I'm Dean Mioli, Wealth Management Advisor at Citadel Wealth Management. Welcome to our 2025 year-end tax planning seminar for 2025 and beyond. We have a lot to cover today, but we have really three big ideas that we want to get across to you. Because of some of these tax changes, this could change how you approach, for instance, itemized deductions. Why? Because they raised the state and local tax deduction from $10,000 up to $40,000. And some of you might be able to take advantage of that. Number two, there is now a bonus deduction for those 65 years or older. So if we have two 65-year-olds filing jointly, that could be additional $12,000 in deductions that you might be entitled to. And number three, I really want to stress this point that at Citadel Wealth Management, we take tax management seriously. And one of the services that we offer is a yearly review of your tax return. We're looking for potential tax savings ideas. And it's like going to your doctor. They want to get a blood report to see how things are. We want to look at your tax return because when it comes to financial planning, there is always going to be a tax aspect that we want to make sure we capture. So let's get going. Well, this new tax law, known as the One Big Beautiful Act, was signed on July 4th, also known as OBA. And some of the provisions in the Tax Act are permanent, meaning that it would take an act of Congress to change. Some of the provisions are known as temporary provisions. It's like a carton of milk with an expiration date. They're around now, but they will expire at some point in the future. Also, some of the tax provisions start immediately in 2025. Some will start at some point in the future, and we will cover that. Now, one of the permanent provisions here is the tax brackets. They go from as low as 10% and as high as 37%. So these are the brackets unless Congress changes them. And I'm highlighting it for three different filing statuses. Single and married filing joint are your most popular. There's also the head of household bracket as well. One thing I want to point out is that the best tax planning can be done when, for instance, both spouses are alive, because the tax brackets tend to be much more favorable when you're both alive as opposed to when one of the couple pass, because the single tax brackets are very compressed. As an example, if you have $200,000 of taxable income and you're filing jointly, you're in the 22% bracket. That same level of income as a single filer, you are in the 32% bracket. Everyone kind of has a natural tax bracket, and part of our job is to make sure we keep you in that bracket or try to bring you to a lower bracket. So we want to kind of know where you are, how far can we go and get into it before we get into the next bracket, and what is the bracket below. And that's a good amount of what we do is that tax bracket management. So again, very important service is that annual review of the tax return. Critical. Now, one of the changes under OBA is that there was a slight increase to the standard deduction. Now, what is the standard deduction? When you file as a single filer, the government is just going to give you a write-off of an amount of $15,750. You don't have to approve a dime of your deductions, you just get it. And about 92% of Americans last year take the standard deduction, regardless of filing status. It's just very hard to itemize, and so most people just take the standard deduction. Now, that could change this year because of some of these changes around, for instance, the state and local tax. We'll have to see how that applies to your particular situation. But again, many Americans will take this standard deduction. For a married couple this year, it's $31,500. Again, you don't have to prove a dime. You get that standard deduction, okay? And that was a permanent change. If you want to itemize, we need to plan how you're going to itemize, because where you put deductions, you might have some ability to move deductions from 25 to 26 or 26 to 25. So there's some nuances there that we have to work out. We'll cover that a little bit later. Now, one of the provisions that's starting in 2026 is that you'll be able to write off some of your cash contributions that you make to charity. Again, this doesn't start until next year, 2026. So if you file as a single person in 2026, up to $1,000 you can deduct. And you don't have to itemize. You get this as a non-itemizer. So this would be in addition to your standard deduction. File single, up to $1,000. File jointly, $2,000. So we're meeting with clients right now, and we're asking about charitable contributions. Many people like to give in the end of the year during the holiday season, and some may do all their giving then. So we're trying to understand when they're giving and how much they're giving and how they're giving. Because we might suggest, and we have done this with a few of our clients, don't write the check in December because why? You're not going to see any tax benefit this year. But next year, when you write the check in January, you are going to get a tax benefit. So in one case, one of our clients was going to give about $2,000 in cash to their local church. They write that check in December, no tax benefit. They write it in January, $2,000 check in the 22% tax bracket, which is their tax bracket. They just saved $440 in tax. How about that? Again, the nuances of when to take these tax deductions. Again, it has to be in cash. You can't give away appreciated securities to get this, and it has to go directly to a charity like the United Way, your church, your synagogue. It can't be to like a booster organization or for instance, a donor advised fund. But we can cover that with you in our meetings with you. Okay? Interesting provision, but it doesn't start until 2026. Now, this is one of the ones I highlighted at the beginning, which is this state and local tax. And they blew the roof off of this thing. It used to be $10,000 is the most you could deduct with state and local tax. That includes state income tax, local income tax, property taxes. Okay? Imagine you could pay $50,000 in those taxes, but you only got to deduct $10,000. Well, guess what? That has now been raised to $40,000. And it can phase out, but you have to be at a pretty high income level to start to see that phase out. So once you get to over $500,000 of income, that $40,000 starts to get reduced, which is not going to affect, it's going to affect very few people. So most people will get the full benefit of that $40,000. Pretty amazing to get this much larger write-off that you didn't have. So more people are going to be able to itemize because it's not limited to 10. They'll be able to deduct, in many cases, how much they actually paid in state and local tax. Now, when you look at it now and into the future, currently it's $40,000, but it will be indexed for inflation. So in 2029, it'll be over $41,600. Notice that in 2030, it goes back down to 10. So this is one of those temporary provisions with an expiration date. Okay, so we got to think about how do we take advantage of this now and not lose out in the future. Now, one other deduction I want to talk about, which affects a lot of us, is mortgage interest. And right now, you can deduct interest related to $750,000 of mortgage indebtedness. And this could be on your primary residence. This can be on your vacation property. You can aggregate to that $750,000, okay? And you could also include in that $750,000 home equity lines, okay, known as a HELOC, home equity line of credit. Now, to deduct interest in a HELOC situation, it has to be used, that money has to be used to improve or build your property, okay? So if you took a HELOC loan to pay off a credit card, which could make all the financial sense in the world, it's just not deductible for tax purposes, okay? Now, starting in 2026, and this used to be deductible many years ago, something called mortgage insurance premiums. Now, when you get a mortgage and you put less than 20% down, the mortgage company is going to ask that you pay this premium, this mortgage insurance premium, to kind of protect them on the mortgage. Starting next year, again, one of these provisions not starting this year, next year, that mortgage premium will be deductible. Okay. Again, mortgage interest deductible up to $750 can include HELOCs, and starting next year, you can write off the mortgage insurance premiums that you might be paying if you didn't put down enough to cover 20% of the purchase price. The rest you can read on your own. We're going to move on. So here's an example, and this was a case we recently worked with a client on, and we were analyzing their situation, a married couple in their mid-50s. They came in and we were doing their annual portfolio review and their tax return review, and they said, hey, let's take a look at this. So right now, projected for 2025, and we made it in 2 columns, pre-OBA, which is prior to the tax law change on July 4th. You'll notice that they didn't have any medical expense, which is not very common because most people have medical insurance and they don't get a medical expense deduction. State and local tax, $7,000. Their property taxes are kind of on the high side, $12,000. Notice before the tax law change, they could only deduct $10,000. They have mortgage interest of $14,000. They have a recent mortgage. It's a high interest rate. Hopefully interest rates will come down in the future. We'll see. Charitable contributions, $3,500. Notice that their total is $27,500. Now, before OBA, the standard deduction was $30,000. What are you going to take, $27,500 or $30,000? Of course, you're going to take $30,000 as a standard deduction. It's worth more. You get a bigger write-off. But now with the tax law change, when you look and compare the 2 columns, what changed? Well, instead of deducting only $10,000 in state and local tax, they get to deduct the full $19,000. So now their total itemized is $36,500, and they exceed that standard deduction of $31,500 by $5,000. $5,000 times 22%, it's going to be over $1,000 in additional tax savings. So there's an example where this new tax law is working for some of us, depending on your situation. And we could look at that for you to see what makes sense and how this new tax law might affect your situation. Now, they're going to take their charitable contributions right on their tax return because they're itemizing, okay? They don't need to think about that special write-off that we talked about earlier, which doesn't apply until next year. They're going to take their charitable contributions. Now, one of the things we talked about with them is, well, you gave in cash, but we might look to do appreciated securities. The stock market has done fairly well over the last 3 years, and in their taxable account, we may be able to gift some of those appreciated securities to charity, and then you get a twofer out of that. One, you don't have to recognize the gain because you gifted the securities to your local church, and 2, we get a tax deduction for it. That's not a bad gig. So again, there's some of the ideas that we work through with our clients. Do we give in cash? Do we give appreciated securities? Or maybe it's a combination of both. Again, taxes are personal, and we have to work through that with you. Okay? Let's move on. Now, this was that second big tax idea I taught you about, was this bonus deduction for those 65 or older. So if you turned 65 this year, you're eligible for this $6,000 bonus deduction. And a married couple, it could be as much as $12,000. Now, let me talk to you about this a little bit. This is available to both people who itemize and take the standard deduction. Now, it's what's known as a below-the-line deduction. And that's important here because when you look at your tax return, the first thing you have is all your income items, and then there's a few write-offs that you could have, for instance, like maybe a deductible IRA contribution, and you get to know what's known as adjusted gross income. We say AGI all the time. These deductions come after AGI, but before one's standard deduction or itemized deductions. So what that means for some of you is it's not going to have any effect on the taxation of your Social Security benefits. It's not going to have any effect on your Medicare premiums. It's not going to lower any of those, okay, directly. But we'll talk more about that. Now, this deduction is available for 2025 through 2028. Again, it's one of these ones that have an expiration date. And there is a phase-out range that you'll notice for a single person. The phase-out range is from 75 to 175, and for a married couple, 150 to 250 of adjusted gross income, AGI. So again, we have to look at that. And this is on top of what's already been in the tax law for many years, which is once you got to 65 or blind, you got an additional $1,600 standard deduction. If you're filing joint, if you file single, it's actually $2,000. So let me look at some examples here. So we have a single filer. They have a tax standard deduction of $15,750. They have this bonus deduction of $2,000 since they're filing single, and now they have this temporary provision where they get an additional $6,000. So they're getting a total write-off of $23,750. Pretty good. Now we go to the situation where one of the spouses is 65 or older. So your standard deduction is $31,500. You get your $1,600 because one of them is over 65, and you get the bonus of $6,000. You're at a total of $39,100. Well, what if both spouses are over 65? Now $31,500 plus $3,200 plus $12,000. So it could be as high as $46,700. And you don't have to prove a dime of deductions. The government's just going to give this to you based on age and your filing status. Now, that could very well help potentially lower what portion of your Social Security is taxed. So let's go over that. It's not direct. The president talked about no tax on tips, no tax on overtime, and we're going to cover that. But there was nothing in there that says no tax on Social Security. But let's look at an example. So here we have a married couple. And again, someone who came into our office, year-end tax review. Dean, what's going on? How's this tax law affecting me? They're in their late 60s. They have interest and dividends of $2,500, Social Security. The taxable portion, their actual amount that they brought in was higher than this number, but the taxable portion, $47,000. IRA distribution, $6,000. Cap gains, $1,500. Total income, $57,000. Now, deductions. All right, they have both of them over 65, so we got $6,000 times 2, $12,000. Plus, they were already getting the $1,600 per person, so times 2, $3,200. Standard deduction, $31,005. Total deductions, $46,700. So their taxable income is $10,300. That puts them in the 10% tax bracket. And you could see that total deduction of $46,700, it almost equates to what their Social Security is. So I can't say that it's a direct write-off of Social Security, but it certainly put a big dent in how much that Social Security was taxable. But some of the ideas that we talked to them about was, one, look, they took that IRA distribution because they needed some extra cash flow. They're not of age to take the required minimum distribution, which doesn't start for them until they turn 73. So we said for 2026, we're not going to recommend you take an IRA distribution because if we were to harvest long-term capital gains, which is normally a taxable item, you sell a stock that you bought for $1 and sell it for $5, that's a capital gain of $4. And if you held it for at least a year, it's a long-term capital gain. But the fact that they're in the 10% bracket, the long-term capital gain rate and the qualifying dividend tax rate is 0. So instead of paying taxes on $6,000 in an IRA distribution, we're able to raise that cash flow that they're looking for with a 0 tax bill. And that money stays in the IRA and continues to grow tax deferred. And that also might change how we generate dividend income. But again, qualifying dividend income, we're not going to get into how that comes about. But the point being is we know how it comes about. And that is also could be taxed at a 0%. I much rather raise cash paying 0 than generating income that's going to be taxed. Okay? So this is the type of tax planning that we're working on with our clients. And of course, we do incorporate working with their tax preparer. Now, this is a big point here because most of you out there work with do it yourself, which is great. I do my own taxes, or you're working with a tax preparer. And that meeting is going to take place early next year, maybe February, March, and you're going to provide the data and they're going to put the numbers on the form. They probably even file electronically. You might not even have to physically sign anything. And I get that. And you pay for that preparation, but there's no planning involved. The tax year is over. come December 31st, there's not a heck of a lot you can do. You have to do it during the tax year. You have to think about what you're going to do for 26 and 27. Okay, and that's not normally what you're paying for. You're paying for preparation. We provide this service to make sure that we're looking at that and making sure there's more money that's not going to taxes unnecessarily. Okay, I'm a very patriotic person, but it has nothing to do with the size of my tax bill. Okay, I want to pay the legal minimum. That's my responsibility as a good U.S. citizen, and that's what I do. Okay, and maybe you want to do that too. Okay, let's move on. Now, a couple of other things that happened was this no tax on tips. Okay, the president talked about it. It is part of the tax law. It starts this year. You don't have to itemize to get this. It's available to non-itemizers. The maximum that you can not pay tax on is up to $25,000. There is a phase out, but it's fairly generous. For a married couple, if your income is under $300,000, you're not going to have a phase out of that $25,000. But it's only for professions that normally and ordinarily get tips. So a couple of examples: waiters, waitresses, Uber drivers, taxi cab drivers, positions like that typically get tips. Some professions, like what I do for a living, we don't customarily get tips, so this is not available to me. Okay, and the government has a list we can provide you of all the professions that this would be eligible to. Okay, so it's not a bad little thing. Again, tips have to be voluntary, and so some of you might be eligible for this, and you'll be able to not pay taxes on some of your tip income. Pretty nice. Another one is no tax on overtime. Now, this one's a little tricky, so pay attention. Again, it is available to non-itemizers. The max deduction is $12,500 for single filers and double that for filing joint. Again, there is a phase out, but it's pretty generous. And it's how you're paid is very important here. For instance, let's say I have a job in retail and I normally work a 40-hour week, but my boss says, hey, can you work 10 extra hours this week? Fine. All right, I'll help out. I'm a team player. I'll work 10 extra hours. And I get paid my normal rate. Let's say it's $30 an hour. Well, guess what? Those extra hours, the fact that I got paid my normal rate, I'm not eligible for this deduction. Though, if I was for those 10 hours was paid an overtime rate instead of 30, I was paid 40. Okay, that delta of $10, that would be eligible for this write-off. So it has to be a rate differential to have no tax on overtime. Now, this only covers federal income tax, okay? Meaning you're still subject to payroll taxes like Social Security and, for instance, state income taxes, okay? This is only federal income tax we're covering here. Though it's a nice bonus. I suspect that this could help union workers quite a bit because they tend to, if they work overtime, they work weekends, holidays, and so on. They usually get an overtime or two times their normal rate, and this could very well help them quite a bit. But again, it's just federal income tax. Other taxes are still applicable. Now, another deduction is the auto loan interest. And certainly just remind everyone here that another ways we help our members is that as a credit union, we lend. So we do HELOCs. We do mortgages, and we do auto loans, okay? So we can help with that side of the balance sheet just as much as we do asset management. We can also do liability management. And this deduction is available starting this year in 2025, though the new loan or refinance has to have been after December 31st of 2024, December 31st, 2024. So the vehicle can be a car, a van, an SUV, a pickup, a motorcycle, okay? But the car has to be assembled in the U.S. Not all the parts have to be made here. The parts could come from Canada, Mexico, maybe somewhere in Europe, but the car has to be assembled here to be eligible for this deduction. And there's plenty of cars that are made in this country, not just from U.S. manufacturers, but foreign manufacturers as well. Point being is you can check that by running the VIN number or it's even on the door sticker. If you were buying a new car, you can see it right there. And it could be for more than one car. So let's say you bought 2 new cars in 25, or bought a used car in 25 and a new car in 25. You can deduct up to $10,000 of that interest, and it's available to everyone. You don't have to be an itemizer. It's available to non-itemizers, so anyone can write off this auto loan interest. And if you're looking for a car loan, come see us at Citadel. We do quite a bit of car loans here at Citadel. And again, there is a phase out. It's pretty generous. It can be starting at $100,000 for a single filer, and for a married couple, it would start at $200,000, meaning you would lose some of that ability to deduct that full $10,000. That would be quite a bit of interest in reality. $10,000 is quite a bit of interest, but nonetheless, it is subject to phase out. Okay, expanded rules for 529 plans. Okay, people have money in 529 plans. They were diligent about their savings. They may have put extra money into these 529 plans, and now like, well, I want to get some of this money out. And so now you could always use the 529 plan for children through kindergarten through 12, but it was only for tuition. Now you can use it for other things. For instance, books, tutoring, as a couple of examples. Could be for speech language and some other disabilities, things like this. Now, this year it's limited to $10K. You can take out tax-free if it's used for these purposes. Starting next year, it goes up to $20K per year, okay? And interesting is that it only applies for expenses incurred after the bill's passage, which was July 4th. So if you incurred a book expense for a 10th grader in January, you can't write that off or pull money out from the 529 to cover that. That would be taxable. It has to be for expenses post or July 4th, essentially. Okay, so that's a nice provision. There's a lot of money that's been trapped in these 529 plans. Talk to us at Citadel. We might have some ideas for you on how to untrap some money that, for instance, people have had kids in college and they got scholarships and they said, what am I doing with all this money in 529 plans? There are some provisions that we could help you with to unlock that money. And another interesting provision was that you can use 529 plan money to pay for instance, credentials. Now, myself, I'm a certified financial planner, I'm a chartered life underwriter, and Citadel, we have some up-and-comers that are going for their certified financial planner. Citadel does reimburse for the classes for those designations, but we don't reimburse, for instance, for the exam fee. Okay, it's just company policy. It's all right. Point being is, if these individuals have a 529 plan, they could pull money out of the 529 plan tax-free to pay for those exam costs. Okay, pretty cool. So it has to be a recognized industry designation, like, for instance, certified financial planner. I got mine many, many years ago. All right, child tax credit. We're coming here to the end. Increased to $2,200. It was a $200 bump in 2025. It's going to be indexed to inflation starting next year. There is a phase out, but it's pretty generous. Okay, for a married couple, the phase out doesn't start until $400,000 of income. That's way up there. And the phase outs are not indexed, which is nice. And there's actually a refundable portion. And what I mean by that is, and it's up to $1,700. So as an example, if your tax bill was $1,000, and then you were eligible for, let's say, a $1,200 child care credit. So the child care credit would wipe out your tax bill of $1,000, since the credit was $1,200, and that $200 that's beyond your tax liability, you could put in your pocket. There's really two types of tax credits that are refundable. One is the child tax credit. The other one is the earned income credit. Okay, key takeaways. It's really imperative that you meet with your financial advisor and discuss your financial situation. Here at Citadel, we want you to have the best life with the money that you have. And if I reduce my tax bill by being tax smart, you'll have more money. Pretty simple. What's not simple is the tax law, because it's constantly changing. And that's why you have to meet with your advisor on a regular basis. And things happen in life. And then we need to get on our front foot when it comes to tax planning. We're much better to be proactive with planning as opposed to reactive with planning. The options are much more available to us if we get in front of things and plan for things. And that's really what excites us. That's our passion. That's what we do here. This is what we love to do. And you want to work with people who love what they do. So again, tax planning is a year-round exercise. It's a multi-year exercise. I'm not looking to reduce the tax bill in 1 year. I want to reduce it every year. Okay? Again, we're year-end tax considerations. We're working with clients on whether they should take gains in their portfolio or tax loss harvesting if available, depending on your tax brackets, right? If you happen to be a lower bracket, we're probably doing tax gain harvesting. In a higher bracket, we're doing tax loss harvesting, how to handle charity before year end. Again, that example I ran where we're going to push deductions into 2026, okay? And then RMDs, required minimum distributions. Did you take your RMD for this year? Okay? No, yes. Should I do a qualified charitable distribution? We're not going to cover that today, but that's something you might want to talk to your advisor about. That will reduce your AGI. That will reduce your income. That might make sense for you, okay? So you got to talk to us, and we can come up with ideas that make sense for you. So again, sit down with your Citadel financial advisor. What can you expect? And review your tax return. Discuss potential tax savings ideas and tax planning ideas. Analyze the potential impact of OBA, also known as HR1. Review your current investments into bank deposits to make sure they align with what you're trying to accomplish. Okay, many of you are out there are about to enter retirement, in retirement, late retirement. Things are changing. You know, who's this money for? Am I generating the right amount of cash flow? Is it the right type of cash flow in the right type of account? Asset allocation, asset location. Continually monitor the situation. Get in front of what's going to happen in life. Now is the time to book an appointment and meet with your Citadel financial advisor, because we might need to do some things before year end. Okay? But the sooner the better. Okay? Thank you for your time and your interest. And again, this is D. Mioli with Citadel Wealth Management. Thank you. Bye.